Chapter 2: Revenue, Expenses, and Profit. What is revenue? Well, revenue is the income generated by the sale of goods or services related to the company's primary operations. It's calculated as the average sales price times the number of units sold. But what's the difference between revenue and profit? Well, revenue refers to a company's income as a whole, while profit refers to the income left over after paying for expenses. We'll be looking at the different kinds of expenses and the different types of profit that result. Cost of goods sold, or COGS, refers to expenses directly related to the production of a product. Examples include labor directly tied to production, direct materials needed for the production of goods and services, and taxes on the production facilities. Cost of revenue refers to the total cost of manufacturing and delivering a product or service to consumers. It takes into account the cost of goods sold, COGS, or cost of services provided, plus any additional direct costs incurred to generate a sale, such as distribution. Operating expense refers to expenditures that are not directly tied to the production of goods or services. Examples include sales and marketing, rent, payroll, insurance, utilities, office supplies, and legal costs. Now let's summarize. Costs of goods sold, or COGS, refers to expenses directly related to the production of a product. Cost of revenue takes into account the cost of goods sold, COGS, or cost of services provided, plus any additional direct costs. Operating expense refers to expenditures that are not directly tied to the production of goods or services. Now let's look at the different types of profit. Gross profit, or gross income or sales profit, represents the income or profit remaining after the production costs have been subtracted from revenue, or costs of goods sold. Gross profit margin shows the gross profit as a percentage of net sales, or revenue. The formula is gross profit divided by revenue times 100, which results in a percentage. Operating income reports the amount of profit realized from a business's ongoing operations. The formula is revenue minus costs of goods sold minus operating expenses. Or it can also be written as gross profit minus operating expenses. Operating margin represents how efficiently a company is able to generate profit through its core operations. Higher margins are considered better than lower margins. The formula is operating income divided by revenue times 100. Net income. Net income indicates a company's profit after all of its expenses have been deducted from revenues. The formula is revenue minus costs of goods sold, COGS, minus operating expenses, minus other business expenses, minus taxes, minus interest on debt plus other income. It can also be written as or net profit margin measures how much net income is generated as a percentage of revenues received. It's one of the most important indicators of a company's overall financial health. The formula is net income divided by revenue times 100. Now let's summarize gross profit, operating income, and net income. Gross profit is a company's profits after subtracting the costs of producing its products. Operating income reports the amount of profit realized from a business's ongoing operations. Net income is the company's profit after all its expenses have been deducted from revenues. It's an all-inclusive metric for profitability. Here are the profit margin ratios, which are all expressed as percentages. Now let's look at an example of Apple's financial statement. This is Apple's income statement. Here we can see some of the familiar terms we went over in this video, such as total revenue, cost of revenue, gross profit, operating expense, operating income, and net income. Feel free to visit the Yahoo Finance website and explore the financial statements of the many companies.